Welcome to Manifested Publishers. My name is Mr. Dongo. I am an economics lecturer. Today we'll be covering that is Economics August 2024 paper, question 4, and we start with Roman A. We read the question, then we put it on the board. It says this: state 5 factors that limit the success of economic integration in developing countries. I repeat, state 5 factors that limit the success of economic integration in developing countries. State 5 factors that limit the success of economic integration in developing countries. So state 5 factors that limit the success of economic integration basically in developing countries. Developing countries, first of all, are countries that are not yet developed. They're in the process of developing. And when you talk about economic integration, we talk about these countries coming together basically to facilitate trade amongst member states. And you said one of the examples of this economic integration, a given example is like the COMESA, where you find developing countries coming together in order to facilitate trade. A given example of economic integration is COMESA, where countries come together to facilitate trade amongst member states. In the quest to facilitate trade and facilitation of cooperation amongst member states, there are a number of factors that basically hamper such integration. And some of the factors that we know basically does that is lack of trust amongst member states. We also have a number of things that deals with political instability, probably in the continent where those developing countries are. We can also talk about the difference in currency, may also hamper such integration. But you also know that there is violation, where you find some other members may violate the agreements that are basically enforced in such integration. We can also talk about some of the reasons that why these integrations may not work is difference in the level of technology. The countries that are probably more developed in terms of technology than other countries, and so with such, they may not be able to engage in such integration. But lastly, we can talk about a number of things like external influence. You can find countries that are not within the integration actually coming in and causes mayhem in such agreements. And therefore, at the end of the day, you find that such integrations are not facilitated. We can put them on the board. Say one, lack of trust amongst the member states, lack of trust amongst the member states. Number 2, we have what we call violation of agreements. We have number 3, very important, we call it external influence. External influence. So we can also have political instability, what we call political instability, within the region. Political instability within the region. And lastly, we can talk about what we call difference in currencies. What we call difference in currencies. Difference in currency. We can add one. We have that is difference. What we call difference in the levels of technology. Difference in the level of technology. That when we have difference in the level of technology, that may also hamper agreements within the integration. And that is basically how one should approach this very question. And in looking at that question, the examiner is very clear that he needs 5 points. So the 5 points meaning that each point is equivalent to 1 mark. So as you do that, you must make sure that you're within those points and you can provide extra so that you stand a chance that even if you're not in a position to get the second or you're not able to get the third, but you have an extra mark on that, then you'll be able to get the whole question. That is how we basically approach that very question. We pick it on the next question, still on question 4, Roman B. So this is what the question says. Distinguish between debt distress and debt conversion. So we put it down on the board. We put it down on the board. That is B. Distinguish debt distress and debt conversion. Distinguish debt distress and debt conversion. Distinguish the debt distress and debt conversion. One of the things that comes to our mind is when you talk about debt, we need to understand that being in a developing country, and Kenya one of the developing countries in Africa, we need to understand that one of the major policy issues is management of debt. Because you realize that these countries are not able to fund their budget, that most of their budgets are funded through debt. And so therefore, then there's need for proper debt management in such countries. And some of the terminologies when you talk about a numbers of issues pertaining to debt, we'll have what we call debt distress, and we have what we call debt conversion. To be precise, when you talk about debt distress, is inability of a country when a country is unable to fulfill its financial obligation. That is the debt distress. When a country gets to a point that is not able to fulfill its financial obligation as a result of the debt, that is what we call debt distress. And debt distress basically will lead to what we call debt restructuring, that you need to restructure the debt as a result of the distress that comes as a result of not being able to fulfill financial obligation. On the other hand, when you talk about debt conversion, we are basically saying that conversion of a short-term loan to long-term loan and vice versa, where we typically say that we typically exchange debt at sustainable discount. Exchange the debt at a sustainable discount. We can put it down and say debt distress. We say that debt distress is inability, is a country inability to fulfill the financial obligation. That is what we call a debt distress. And debt restructuring, and therefore debt restructuring is required, and therefore debt restructuring is required. You get to a scenario where you are so much faced with the debts that you are not able to fulfill your financial obligation, and therefore what we call the restructuring of debt basically will be necessary in such circumstances. Then we proceed to what we call debt conversion. Debt conversion. What we call the debt conversion. So when you talk about when you talk about debt conversion, we basically say refers to the conversion of short-term debt to long-term debt, conversion of short-term debt to long-term debt, and vice versa, conversion of the short-term debt to the long-term debt, and vice versa. Or we can basically say that exchange of debt, what we call exchange or stock exchange of the debt. We say stock exchange of the debt, typically to a sustainable discount. Typically to a sustainable discount. That is what we call a debt conversion. That is what basically we call a debt conversion. And very important to understand again on these very questions that we have, very important to understand is that if the marks is allocated 4, it therefore implies that once you define the debt distress, that should account for 2 marks, and debt conversion 2 should also account for the 2 marks. That should also account for the 2 marks. And that's a question that is doable and manageable. And if you look at this, this is one of the areas that actually affect, is one of the emerging issues, especially to the developing countries. And is one of the areas that learners need to pay attention. Because if you look at these countries that are developing, Africa and having a majority of the countries that are developing, they're faced with a number of debt issues. And so we need to give much attention to that. That is how we approach that very question. We'll pick on our next question. That is August 2024. That is question 4, Roman C. We'll read the question, that we put it on the board. Outline 6 method that may be adopted to clear external debt in developing countries. Outline 6 methods that may be adopted to clear external debt in developing countries. We raised and said that debt is a major policy issue, meaning that debt is a factor that needs to be considered. We said majorities of these countries that are in developing world rely mostly on debt. Why that? The reason is that because they're not able to fund their budgets using their own sources of revenue. And so they have to rely on debt that is basically from developed countries in order to fund their budget. So the examiner clear is asking us, how do we get to reduce? What are some of the methods that we get to clear external debt? Because these obligations actually affect the growth of a country. So we can put that on the board. Outline, that is C for C. Outline 6 methods. Outline 6 methods that may be adopted, to clear external debts in developing, countries, something very important to understand about when you talk about debt management, those are basically touches on macroeconomics. And this is one of the areas, again, also, you're not so much limited into approaching these questions. It's not limited to what you find lecturers will give, but this is a very open way if we look at our country, for example, Kenya as a case study, what are some of the ways that are very common in a country dealing with clearing external debt? One of the very common that we know as the citizens of a country is that, that the country uses, Kenya being a case study, is widening of the tax bracket. One is what we call it widening of the tax bracket, tax bracket. That essentially means that i.e. increasing the taxes, i.e. increasing the taxes. That one of the ways that they deal with the external debt when it's too much, and how they manage it is increasing the taxes. We know that number two is what you call austerity measures, where government reduces. Also a measure, Kenya being a case study, we know that a country is dealing with a lot of austerity measures, where a country is reducing expenditures. Number two, reducing a country's expenditure, so that much of the money that is available can be used in order to pay the debt, And very important, number three, we talk about debt conversion. And debt conversions, we basically say that you can convert short-term debts to long-term as a way of reducing. So we talk about number three, what you call the data conversion, i.e. converting short-term loans to long-term loans, and vice versa, to long-term loan and vice versa. Converting short-term loans to long-term loan and vice versa. We know that when you talk about long-term loans basically take a longer time for them to be repaid or for them to be cleared. A country may decide to dealing with this long-term loan and making them short-term so that they can clear them within the period. So we can also talk about what you call increasing government borrowing. Increasing the government borrowing. You can also increase the government borrowing in terms of internal. You can increase the government borrowing in terms of internal so that you can repay the external debt. Increasing the government borrowing, increasing the government borrowing from central bank to clear. We say to clear external debt. Debt. But very important, one amazing thing that a country can do. A country can also decide to seeking what you call debt forgiveness. Seeking debt forgiveness. The number of points that you can be asked where we say a country can refuse to pay debt as a way of doing away with the external debt. But the most precise and most clear way is seeking of what you call debt forgiveness. But you can also touch on what you call promoting investment so that they can have money to pay the debt. Say promoting investment so as to generate profits to pay up the debt, to pay up the external debt, so as to pay up the external debt, so as basically to pay up the external debt. that they can promote investment within the country, so that they can pay up the external debt. So they can also decide to avoid rescheduling of the loan. But that basically touches, because you can have it, touches on conversion, avoiding avoiding rescheduling of the loans. We can have that as the last, avoiding. We can have it as avoiding rescheduling of the loans, so as to pay up in time. So as basically to pay up in time, that the country can decide to avoid rescheduling of these loans, so that they are able to pay them up within the required time. That is how we basically approach that question on how do we reduce, what are some of the methods that basically we use to reduce the external debts. We'll pick it on our next question. That is August 2024, question 4, Roman D. This is what the question says. Highlight 5 limitations of quantitative theory of money. Highlight, we put it down. Highlight, question 4D, highlight 5 limitations. 5 limitations of quantitative theory of money. Highlight 5 limitations of quantitative theory of money. So we need to understand what basically quantitative theory of money talks about. So when you look at quantitative theory of money, it basically talks about MV, which is money supply times velocity, is equals to price levels times the number of transactions, A number of limitations that are basically envisioned in this theory are that the theory does not address one of the limitation. We say number 1 limitation, the theory does not address the issue, what you call the issue of interest rate. Does not address the issue of interest rate. And we basically know that interest rate is one of major policy on monetary policy. Monetary policy that we know we use to address a number of issues, in economics. We can also have number 2 limitation on this theory. The theory does not address the future. We basically say the theory does not address the future. This theory does not basically touches on the future. The theory does not address the future. Then we can also talk about is too much concerned. Number 3, we can say too much. We say too much concerned with money supply. Too much concerned with money supply, that is circulation of money supply, and ignores the demand for money. So when you look at the formula, one of the things that we have on that theory, it's concerned money supply times velocity is equals to the general price levels times the number of transactions. So this theory basically focuses on issues to do with the supply of money, but ignores what you call the demand of money. Then the theory does not explain changes in the value of money. We see that the theory does not explain the changes, what you call the changes the changes in the value of money, in the value of money, does not explain the changes in the value of money, and not how money, does not explain. The theory does not basically that attempts to explain. This is basically a term. Attempts to explain. Say attempts to explain changes in the value of money, but does not. But not how. But not how. We say not how. We say not how money attempts to explain changes in the value of money, but not how money is in the first place determined. How money in the first place determined. Not in the first place determined. We can look at the last when we have the last on that. This theory argues that there's no general price level. Argue that 5 argues that there is no general. There is no general. Argues that there's no general price level. Price levels. But rather, we say but rather, series. There's no general price level, but rather series of price levels, series of change in price levels, series of change in price levels, series in change in the price levels, in the consumer price index, in the consumer price index. So those are basically some of the limitations that are basically attached to the theory, that is the theory of quantitative money, or theory of quantitative theory of money. One we've talked about does not address the issues to deal with interest rate. We also know that it does not address the future. We also understand that is too much concerned on money supply and ignores the aspect of demand of money. We know that the theory attempts to basically explain the changes in the value of money, but does not address how money in the first place is determined. How in the first place it's determined. That is how we approach that very question. That marks the end of question 4.